Finom is an online platform started in the middle of last year in the summer of 2014. We're an independent third-party platform that connects you with the best investment advisors for your specific investment goals and interpersonal preferences. The genesis for Finom started when both David's family and mine had terrible experiences with investment advisors whom we sourced through the standard word-of-mouth channels. And as part of that process, we realized that initiation is broken. There really is no independence, transparency, or rigor when it comes to finding and hiring the best investment advisors for your goals and needs. So later on today, we will get into exactly what we're doing, why we're doing, and how it's different. But first, let's get to the industry as a whole and talk you through how you should interact with this industry the best you can, whether or not you're interested in our service. So the first question on the table is, why do you really need an investment advisor? Do advisors actually add value to your financial planning and your wealth management? And now there are two stories here. On the one hand, it looks like investment advisors do a terrible job. So most people, unfortunately, are not satisfied with their investment advisors. When it comes to women, who today control a majority of the liquid investable wealth in the country, not even 1/3 are satisfied with their investment advisors. And when you look at certain high net worth individuals, for those with over $1 million in investable assets, only 2% are actively recommending their investment advisor to their friend. In any other industry, this would be a disaster. So on the one hand, it looks like there's deep dissatisfaction and investment advisors are doing a terrible job. But there's another side of the story. So we know that investment advice as an industry is growing. Moreover, we know that a good advisor can add significant value to your investing life. There are many ways to measure this. One quick way to demonstrate this is through a measure that Morningstar came up with called Gamma. So Morningstar estimates that the value of financial planning, of sound financial planning, and by extension the value of a good investment advisor, equates to about 2 percentage points a year, every year, to your retirement. If you're not quite sure what 2 percentage points a year means, using historical returns, that 2 percentage point difference could be the difference between retiring with $600,000 or $1 million at retirement over a period held over 30 years for $100,000 invested today. That's a significant difference in outcome. And it's worth mentioning that 2 percentage point difference does not come from chasing performance. This is all risk adjusted. So this comes from sound financial planning. It comes from areas like goal-based investing, tax-efficient investing, a broad diversification, low-fee funds, and sound cash management. Moreover, the value of a good investment advisor is really compounded and magnified when individuals and families are undergoing periods of transition. So let's say you're getting married or getting divorced, you're having a new child, or that kid's off to college, maybe you become disabled, or you're looking at retirement. Increasingly, we're finding individuals entering long-term care or their parents entering long-term care. And these are all specific areas where an investment advisor can either help you plan for and manage these events and have a dramatic effect on both your ability to financially deal with these events and your investment portfolio generally. So here are the two sides of the equation. On the one hand, you're seeing deep dissatisfaction among everyday investors with the investment advisory industry. And on the other, you're seeing that the industry is growing and a good advisor is adding significant value to your life. So what's going on here? It turns out that the mechanism by which people find, compare, assess, and hire advisors is missing and broken. Right now, all you have to go on really is word of mouth or paid listings. And neither of these are either transparent or personalized. And this is where Finom comes in. But before we get to our specific proposition, let's say you're not interested in our service and you're just here to learn on your own. If you're looking for an investment advisor, how would you evaluate an advisor for quality and for fit? And we think we could help you with this and quickly walk you through a rubric, if you will. The first item on here is you need to understand exactly who you're dealing with. And that affects both the firm that you're working with as well as the individuals you're dealing with. So this may sound technical for a second, but it actually turns out to be really important. So let's start with the structure of the advisory firm you're dealing with. And here there are two ways to look at it. There are independents on the one side and the wirehouses on the other. So wirehouses are firms like Morgan Stanley, Wells Fargo, Merrill Lynch, and UBS. Together, they control about 40% of the total investable assets managed through investment advisors in the US. At Finom, we believe that wirehouses are losing both advisors and money for a reason. Wirehouses are shrinking for a reason. It is because they're concentrated on asset gathering and not asset management. They're concentrated on large accounts and not on servicing smaller accounts. And there really is no direct, immediate incentive for individual investment advisors to cater to all the soft services that you might want, the personalized service. Which is why both advisors and money are leaving wirehouses. And we think among the investment advisor as a set, you should go independent. On the other side of it, there's a difference between an investment advisor and a broker dealer. So you could have a financial advisor, quote unquote, who is a representative of a broker dealer. So broker dealers together as a group, again, control about 30 to 35% of the total liquid wealth managed through advisors, largely speaking. And the issue with broker dealers is they're compensated on commissions. They're not compensated on fees. So that's a fundamental conflict of interest if you want your investments managed as a fiduciary in your stead. Independent investment advisors, which is the group that we're solely dealing with, are independent fee-only fiduciaries. So they're not connected with the bank, brokerage, or wirehouse. They never receive a commission or a kickback in any of your investments, and they're required by law to place your interests above their own in every situation while managing your portfolio. However, if you're talking to a wirehouse representative, understand that you're speaking to somebody within that structure. And if you're speaking to a broker-dealer representative, understand the structure and how they're compensated. If you could go right to the bottom, you can look for issues in the regulatory records, either with the SEC or with one or more states if they're an advisor, or with FINRA if they're a broker. Then you should see what services they're offering. Largely speaking, a broad spectrum investment advisor offers three types of services. There's financial planning, which is understanding where you are in your financial life, sort of what you want from your advisor, what are your specific goals, and carving out a financial plan specific to your needs. Then there's the asset management component, which is allocating your assets, hopefully in a tax-sensitive, broadly diversified, sensible, long-term manner among different asset classes. There's a variety of ways people do this. You have passive and active managers. You have specialists and generalists. So understand exactly what you're buying there. And then you have a variety of auxiliary services. So investment advisors typically differentiate themselves by virtue of quarterbacking your entire financial life. So they're providing tax advice, accounting, insurance, increasingly long-term care, and other such services, whether they're providing this directly or in partnership with other service providers. This is what a broad spectrum investment advisor typically provides. So you need to understand exactly what you're buying from them, whether it's financial planning and or asset management, and whether there's an auxiliary services component on there. So typically, when it comes to fees for a broad spectrum advisor on a reasonable portfolio size, say $500,000 up, you could expect to pay about 1 percentage point on the entire assets under management for mixture of planning, asset management, and auxiliary services. Then the real diligence you can do is ask for a sample of their work. So if they're a financial planner, ask them, how do you come up with a financial plan for somebody with my goals and needs? What is your process? If they're an asset manager, ask them for model portfolios for somebody closest to you. The immediate pushback you're going to get is, hey, wait, everything I do is independent, is highly bespoke, and is tailored to the specific needs of every client. I've got 100 different clients with 100 different life situations and 100 different mandates. Let's talk about your specific situation. While that is true, don't take that answer at face value. Understand their process. Understand how they come up with either a financial plan or a portfolio for somebody closest to you. Understand their thought process. Look at their investing style and thesis. What securities are they invested in? What are the fees that they pay on those securities? How do those investments do over time? What is the total riskiness of the portfolio as a whole? What is their position on tax-efficient investing? What strategies do they deploy? How do they think about diversification? try and get to the nuts and bolts of their process. And then finally, go about 6 months out. Do a little thought experiment with them. Ask them, let's say 6 months from now, the market tanks by 30%. How will that affect my financial plan? How are you going to counsel me on the phone or in person when I am freaking out about my investments? Ask them if I become disabled or I have to retire prematurely. How will that affect my family's cash flow needs? My family's cash flow either in retirement or leading to retirement. Go through a couple of hypotheticals like this with them, both having to do with the market and with your personal situation. And then see how competently, creatively, and sensitively they handle that. Because often we're finding that the best value of an investment advisor is really to stop you from doing stupid things with your money in scary times. That they can be a proper counsel to you on your investments in addition to just implementing what you agree on. So here's really what you can do without a service like Finom if you're looking to hire an advisor like yourself. It will help you certainly over simply looking at their records or reading their marketing materials. But the bad news is that having gone through this process with literally hundreds of advisors, it's been disappointing to us to see how our ex-ante sense of how an advisor would manage our money based on our interviews with them, looking at their style and thesis, going through the process we talked about, matched up with our analysis of their portfolios that they actually place their client assets in. There's a fundamental disconnect in your ex-ante sense of how they're going to manage money, how they're going to plan your finances versus what they actually do. And here is Finom's focus. It is a focus on data, a focus on personalization, and a focus to bring you intelligence on how investment advisors actually manage money for clients just like you. With that, let me turn you over to my partner, David, who's going to talk you through our process.
Thanks, Aziz. So the real focus of Finom, as Aziz was saying, is to try and understand who you are, what your needs are, and to help you find those best advisors for those needs. So the first thing that we do when a prospective client comes onto our website is we put you through a basic questionnaire. So if you can see the screen, you'll see some of these questions that are coming up. We're basically trying to do a few things. The first thing is understand where you are in life, both in the broader sense and also in the very specific sense of geography. But understand the key demographic things that drive a relationship. So asset levels, for example, are important for being above specific advisors' minimums, but also for gauging fee levels. One of the key things that we do is make sure that everything that we look at is net of fees, so that if Aziz and I were to go to the same advisor, we might end up with different fees if we have different asset levels, and we want to make sure that that's adequately represented in our analyses. We'll also look at basic information on how long what your investment horizon is, if you're looking for a short-term investment or for 20-year type investment, a little bit about your investment experience and so on. We also go into then some risk type of questions, trying to understand what you think of risk. What does risk mean to you? Do you enjoy risk? And really what we're trying to do is get to an understanding of what your risk tolerance is. Are you a very conservative investor, or are you a little more aggressive with a longer term horizon and are willing to bear 30% market moves or more during specific times in financial stress or financial market stress? The third type of thing we'll ask is about special services that you're looking for. So we try to understand, what's important to you from an advisor. Are you looking for, big advisory firm or smaller advisor firm? Are you looking for, someone that's been around for 50 years, or for someone that, maybe you don't care, they've only been around for a few years, but are the right type of advisors for you? Look at what kind of investments that they hold. Maybe you're looking for someone who's very specifically focused on international, developing market equities, or perhaps something different. And so with all of this, we're able to basically come up with a recommendation and a rating for some advisors in your area based on your geographic preferences and based on our analyses of what we know about you and what we know about the advisors. And our real goal is to try and simulate on a risk-adjusted and fee-adjusted basis what your investment tenure would have looked like had you been a client with any of these advisors. So often they'll try and provide model portfolios, but really these are kind of spurious in the sense that even the advisors that really try to adhere to a specific model for all of their clients or big subsets of their clients, the execution is a big factor that at the end of the day is not the same. Maybe you have specific needs on one side of a type of portfolio, or you work in an industry that you want to try and avoid exposure to in your portfolio, and so on. So there really are differences that manifest themselves even with the best of intent. But very often the model portfolio really just serves as a ex post or after the fact marketing material. It's great you invested in Apple in 2003 or 2004. It's hard to prove these things. So what we really are doing again is trying to help you provide a concrete picture of what things would have looked at. Because of the level of data that we are able to collect from these advisors, we're really able to show which of the advisors' existing clients are sort of most like you, and then simulate everything from there. So here's our advisor listing page. If you're on the phone, not on the screen, basically we're showing a little bit of a screen with different advisors and certain characteristics and simulated performance numbers, information about the advisor's practice, the estimated fees based on information we have about you, and also based on what we know about the advisor's fee structures, when they were around since, their returns after fees, and a rating for that advisor that we're providing. So let's click on this enthusiastic advisor here, and we can see a few things going on here. The first thing is we've got some headline performance type numbers on year to date, 1 year, 3 year, 5 year. We've got volatility information to compare, but maybe you don't really care about or you don't really want to dig into all these details and have that be a driving decision point for you. We do distill it down into these ratings, which kind of encompasses a lot of different factors that you've provided us and that we've received from the advisors, and trying to turn that into something meaningful that works. So we'll provide information again on how long they've been around for, their background. So this firm here in particular is one that's majority female and employee owned, multilingual firm that has a presence across the country. They also are equity focused, and we can learn a little bit more about their socially conscious funds and so on, strategies that this firm practices. But if you really want to dig into the data, we can facilitate that. So on a very basic level, we'll show a breakdown of holdings and what type of holdings that people, again, like you, quote unquote, would typically have. So this advisor, it's 90% individual stocks. They've got about 10% cash equivalents at this point. And we can also really dig in again to some volatility metrics, and all benchmarked to their relevant to the S&P market here in this case. We can look at downside deviations, Sharpe ratios, drawdowns, betas, alphas. If you know what these things are, awesome. If you don't, we have little question bubbles here that will give you some information on what those mean and how to interpret those. But the key is that we always have this on a benchmark basis against a market type number, which can kind of help make sense of some things. We also talk about the breadth of their services. So this advisor is very narrow. They're not going to be providing you with tax planning, with the tax preparation services. This is really an equity only shop that will really handle the money management side of it and the asset management side. We talk about the portfolio customization. So this is a firm that will really do a lot of above average amount of portfolio customization on a per client basis. So it's not one size fits all. So if you want to be able to dig into more data, we allow this to happen in these pull downs. We can, for example, figure out, what those stats have looked like for equities, so the volatility, Sharpe ratios, and so on. We can also jump down and drill into, for example, large cap stocks or mid cap stocks, or maybe we want to see value stocks or neutral or growth type stocks, or maybe we want to look at energy stocks and so on. So you can really dig into a lot of detail here, as much as you really want, and this is something that is pretty unprecedented. And we can let's look at another advisor as well while we're here quickly. So this is a more kind of generalist manager, and they will do a little bit more variety of things. So you can see, they've got a little bit more of fixed income, some stock funds and ETFs and so on. And we, again, we'll represent all this if you're interested in looking at by the types of issuers of fixed income, and the majority of these are municipal bonds. One of the other things that we do is we facilitate, and I'll just show this quickly, a compare feature. So let's say you want to look at a few different advisors. You can add these to our little compare drawer, and you can take a look on a side-by-side basis how all of these advisors and all the data points that we were just looking at, how they compare and what these different advisors are like. From here, and this is the real key for what we're trying to offer is, this isn't the be-all end-all of your research process. We've always found the handshake to be an important part of an advisor-client relationship, and we don't want to replace that. Quite on the contrary, we believe that to be essential and something that any individual has the capability of assessing and analyzing for themselves in terms of fit. So what we suggest is that, based on what you see here, use this as a first level screen and say, I want to contact, this advisor and a few other advisors who kind of meet those initial screen, and know that you're meeting somebody who's been vetted, who, is not doing stupid things with their clients, putting them into high fee funds and so on, and is really able to stand on their record as being a good advisor. And from there, meet the people, see if you like them, see if there's a personal rapport, because they kind of do become a family member in many cases, in that they're dealing with the most sensitive information that you have, and someone that you need to trust. But this is, instead of kind of throwing darts at a dartboard by getting feedback from yellow pages effectively, or by asking your neighbor or your friend, this is you're starting off with quality to begin with, and that's the real key to the proposition. And go and see if you like them and meet them. And typically, most of our clients will talk to between 2 and 3 or 2 and 4 advisors as a good starting point. I think with that, we can open up to questions and see if anyone has any questions. Looks like we've got a couple coming in here. So first question is, are you really free? And how do you make money? So the key thing here is we're free to the clients. So we end up being compensated in the event of a successful client-advisor relationship. So this is a fixed fee that is contractually agreed to, but the key point here is that no part of this fee can be passed on to the client by the advisor. So really, if you were to meet the same advisor either through us or not through us, you would end up being charged the same thing. So for the advisors, this is something that they're willing to pay for because they're going out of their typical network, and it's a kind of business development or marketing expense for them that they're willing to bear. Next question, do you at Finom help people choose who to interview? Aziz, do you want to take a step?
Sure. We help you choose to the extent that specific to your goals, your profile, and your needs. We feature people and rate them on your profile. So you can see that for your specific profile, there are advisors who have an enthusiastic rating, while others will just have a reserved rating. You can see below that what you like and don't like about each advisor. So for example, you can see if you want a specialist or a generalist, if you want a broad-based advisor or a more narrow one. Do you want an active or a passive manager? We have advisors who specialize in certain niche client types like small business owners or doctors or the LGBT community, etc. We offer you the rating and we offer you all the information you might possibly want to decide if you want to have a sit-down meeting with this advisor. From there on, you sit down with them, see if you like them and trust them, and if there's a personal relationship. That is the part where we think you can do well. Each of us can look somebody in the eye and see if we like them or trust them. What we're trying to bring to the table is intelligence on who you should talk to in the first place and why. I see another question on there is, how often are you updating your manager performance profiles? So we get monthly data updated quarterly. And I think there's one last question, which is perfect for the last 2 minutes we have on there. It says, if I hire an advisor through Finom, will you continue to be involved in what capacity? We will not interject in the personal relationship that we want you to have with your advisor. As David was mentioning, we think that is absolutely central. We want really that relationship to be founded on trust and transparency, which is why we started this business. From there on, it's your personal connection with the advisor, and we expect that relationship to grow in terms of both its depth and your asset levels with the advisor. We will not interfere. You sign an investment advisory relationship directly with the advisor that you find through us. And again, to underline the point, our service is completely free to you. Anything we charge the advisor can never, by contract, be passed on to you. With that, I see we're coming to the bottom of the hour. So thank you all again for your time and attention.